Good morning, everyone. This is Uday Turaga, and welcome to ADI's weekly webinar series. We'll talk this morning about downstream oil and gas markets as they navigate through this perfect storm. Very quickly, for those of you who are not aware of us, ADI is a boutique consulting firm focused on serving oil and gas, energy, and chemical markets. Within these markets, we work across the value chain. So if you take oil and gas, we do a lot of work in upstream, midstream, and downstream. Within chemicals, we do a lot of work in specialty and commodity chemicals as well. Power markets, we've been fairly busy, but power is an area where we pursue opportunities on a select opportunistic basis. Within these market segments, we support a wide range of clients. We've been around for the past 11 years. The way we differentiate ourselves in the market is in three ways. One is we bring a lot deeper industry expertise. Most of our firm has worked in industry for a few years before they came into consulting. Second, we've built a nice set of data and analytics over the past 11 years, and all of our work is driven through these data sets and analytical tools that we have built. And then finally, as a boutique consulting firm, as a smaller firm relative to our peers, we bring that owner's mindset. We're a lot more client-centric, a lot more responsive to our clients' needs. And over the past 11 years, we've supported over 150 clients through over 400 projects. So we do a lot of repeat work for our clients who keep coming back to us for support. As I mentioned earlier, we work with a wide range of clients. We do a lot of work with the large oil and gas majors, with operating companies, both E&P independents as well as refining independents. A lot of work increasingly with companies overseas in the oil and gas industry, several chemical majors, and then also several players who sell equipment and services into the oil and gas market. Finally, we support a number of private equity and venture capital investors, and as well as their portfolio companies, which can be mature middle market players or early stage technology startups. There are a couple of areas where we have subscription-based research products. One of them is downstream, our downstream market advisory. You can learn a little bit more about it on our website, but it is a monthly report that, in addition to tracking industry fundamentals, also looks at a topic each month in a little bit more depth. Subscribers have access to outlooks for capital spending, estimates of operating expense within the downstream markets. And of course, in addition to that, we track a number of other industry fundamentals like crack spread, turnaround activity, new capital projects that are coming up, and other related issues, along with, of course, forecasts on commodity prices and supply-demand balances. We help clients in a number of ways. A few of them are listed here. At a high level, we can help companies understand what's happening in markets and develop strategic plans in response to these markets. We can support them with sales and marketing efforts, whether it is through market research or voice of customer research. In times of uncertainty like this, we can help clients navigate these markets by gathering insights on business trends, market and competitive intelligence. And then, of course, there are a number of other ways in which we can support clients as well, including investment analysis, as well as supporting key functions like supply chain, procurement, and innovation organizations. For those of you who have been following some of our research under the Perfect Storm theme, you can go to our website where there's a lot more material that's available. We have published two papers. A third one is coming pretty quickly here this week, where we'll talk in a little bit more depth about downstream. But there's a lot of interesting material, and we've gotten very good feedback from a lot of this research that we have been publishing. The first piece that we published on March 20th was Oil and Gas in the Perfect Storm, where we called $10 oil. Of course, what has happened in the last week around negative pricing on the WTI futures contract, was unprecedented and not something that we called for. But the general structural trends around oil prices being depressed for a long period of time and seeing dramatic declines in the near term is something that a lot of our scenario modeling has been telling us. And it has also been pointing some critical insights around the need for additional supply reduction within the oil and gas market. In addition to some of our ongoing consulting work, we have launched a new study that is focused primarily to help clients understand what's happening today. This study is now available. We look at some of the key drivers that go behind what we are seeing today in terms of oil and gas and commodity prices. But more than that, we do deep dives into each of the segments within the oil and gas market: upstream, midstream, downstream, natural gas and LNG, as well as petrochemical markets. We also do an analysis of how all of this is going to impact capital spending, operating spending, and what this means for investors. One of the things that we are offering along with this study is an ongoing monitoring and tracking service. So it's not just a study that you buy, but you'll also have access to all of our proprietary research and analytics through the rest of the year. So if this is of interest to us, please reach out to us and we can share a little bit more. We are also doing webinars every Thursday at 11 a.m. As you know, there are a few other webinars that are coming up. We've added another one on May 14th focused on power and utilities, and we intend to do this on a weekly basis. We expect this to be some sort of a protracted downturn, and we expect a lot of questions to arise in the market and among our clients, and this is an opportunity for us to share some of our thinking on a more immediate basis. And we are seeing a lot of value and getting a lot of positive feedback around these webinars. So please stay tuned, go to our COVID focus page on our website where you can see more information about upcoming webinars and webinar topics that we intend to have every Thursday. I have a couple of my colleagues join us here today as well. Swati Singh leads our downstream market advisory subscription service, and Utkarsh Gupta is an analyst with ADI, supports a lot of our consulting projects. We'll share a few slides here, quickly sharing thoughts on the downstream market, and then we'll do a short roundtable discussion between the three of us while we await questions from all of you who have joined us this morning. So very quickly, clearly it's a difficult time for the industry. We have seen significant volatility in the crack spread in downstream that you see here on the chart on the left. And of course, it is significantly lower than the 5-year average that we have seen of about $15 a barrel or so. This is the traditional 3-to-1 crack spread on the US Gulf Coast. Diesel cracks have actually held up, and we actually saw a nice uptick here for a couple of weeks going in, primarily due to supply disruptions. But in general, we expect diesel cracks to kind of hold up. Primarily because there's been a significant upward impact on diesel demand, just given what's happening in terms of greater use on e-commerce and other industrial activity during this downturn and during these lockdowns. Gasoline crack, on the other hand, is a very difficult story to tell. We saw for a little while negative crack spreads for gasoline, but in general, there's been significant demand destruction that has occurred in gasoline markets. None of us are driving. I haven't filled my car in the last 6 weeks. Because of these trends, right, there's been significant impact on gasoline demand, and therefore gasoline crack spreads have fallen significantly. So when you tally up what is the extent of demand destruction that we see in the fuels market today, that's what we try to address a little bit on this particular page. What we have here, let's start with global gasoline demand. In 2019, on average, the global gasoline demand was 26.4 million barrels a day. In comparison to that, first quarter came in about 7 to 10% lower, somewhere around a little short of 24 million barrels a day. Second quarter 2020 is going to be where we're going to see a significant impact. There are estimates of as much as 35–40% reduction in global gasoline demand in the second quarter, where the bulk of the lockdowns were, during which time the bulk of the lockdowns were initiated. Collectively, we anticipate first half 2020 to see somewhere from 10 to 30% impact on global gasoline demand. We think that there is still quite a bit of uncertainty here, just because of lack of clarity in terms of how the remaining 2 months in the second quarter are likely to evolve. One of the things that we do anticipate is if the world moves quickly out of these lockdowns, we anticipate a little bit of a surge in gasoline demand, and that may potentially allow us to offset some of the demand destruction that we have seen in gasoline. But based on what we know today, we think that that first half number is going to trend more towards the towards the lower estimate than what we have seen in the past. Collectively, for 2020, our estimate right now is that the market is going to be about 10 to 20% lower for global gasoline relative to what we saw in 2019. In terms of diesel demand, I think the picture is a little better, where collectively we see somewhere from 5 to 8 or maybe 10% impact in each of the quarters or on an annual basis. Jet fuel, on the other hand, has been a very difficult story, as you can imagine, and we see a pretty big impact. Collectively, we think that global jet fuel demand is going to decline by 20 to 30% in 2020. And unlike gasoline, we do not expect a rapid recovery in this. If some of these lockdowns end, we expect jet fuel demand to continue to stay low for a protracted period of time. Collectively, all of this is impacting inventory levels, and we are seeing U.S. gasoline inventory at a 5-year high. We don't see as much of an impact on distillates, diesel, and jet fuel in particular. Some of this is because of significant export activity that we saw in the first quarter, as well as in the case of jet fuel, a significant shift away in the product mix within the refineries. Jet fuel production today is about 6 to 7% of total refining output in the US. That is an all-time low. Traditionally, it's around 12% or so. Jet fuel inventory is also low because refiners have the option of dumping a lot of jet fuel into diesel pool. They are fairly similar, and there's a pretty significant chunk of jet fuel, almost up to as much as 50% of output, that can be blended into the broader diesel pool, and we are seeing that happening within the market as well. Now, collectively, of course, because of the demand destruction that we have seen, utilization has started falling. Utilization for last week within the U.S. refining kit was a little short of 70%, as opposed to about 91% 5-year average that we have seen. In general, unlike other regions, the U.S. refining kit operates at very high utilization levels. So this decline that we see is pretty significant. Now, this is more of an average reduction. Refineries in some markets, the Midwest is a good example, are going to be hit even harder because they don't have access to water or export markets, and therefore their ability to export some of their output is significantly lower, and that's going to hit their utilization levels even more. Some refineries that don't have flexibility to shift product mix and yields are also going to see significant impact on utilization levels. Of course, these tend to be relatively less complex refineries, and what that means, though, is that their profitability is going to be impacted even more. We see similar utilization trends in Europe as well as Asia, significantly lower than the 2019 numbers. Now, if you think of China, we saw a pretty significant drop coming out of COVID for them through the end of the year, the first in January of this year. But once as their recovery process begins, we have seen refining utilization jump pretty quickly. This ramp up that we saw happened over the course of 3 weeks, so it was pretty quick recovery. But of course, there's been a little bit of a decline, or some of the growth rate in the rate at which utilization has increased in China has slowed recently, primarily because China also relies on exporting a number of their refined products, and some of those export markets haven't quite come back up. So in general, we expect utilization rate to kind of stay below 2019, at least through second quarter, but one can take a little bit of hope from the Chinese experience to say that you can potentially bring some of this utilization levels up pretty quickly. We are seeing refiners cut runs and utilization rates globally. We have some of those refiners listed here. We have a more exhaustive list as part of our research, but in general, what we are seeing is refiners are cutting utilization by 15 to 20% across the world. When we tally up all the refinery utilization reductions and cuts that we have seen in refineries globally, we think that about 15% of global refining capacity has been impacted, and around 12.5 million barrels per day of refining capacity is either shut down or is being not used at this point of time. Now, refiners have several options in the wake of this situation. One of them is this fairly robust outlook for diesel demand, and refiners that have the ability to swing their product yields are actively exercising those options. So if you take a look at US gasoline diesel production ratio, so this is gasoline output divided by diesel output over the last few quarters, you will see that that number has declined pretty significantly, and operators are doing everything that they can to maximize diesel production and reduce gasoline production. Now, if you go back to the last few quarters, you'll see a fairly consistent number, but this is actually a little bit higher in general than what we see over a longer period of history. One of the reasons for that is there was this big anticipation around IMO 2020, which kicked off this year, and that was going to drive a lot of diesel demand growth, and a lot of refiners had started tweaking their product yields in favor of diesel. So if you go back historically, you will see that this number was actually much higher. So that in some ways limits how much more additional diesel production can be obtained, or how much more product yields can be shifted towards diesel production. Jet fuel, the jet fuel to diesel ratio, we talked a little bit about this earlier, but you can see a pretty significant drop. Essentially, a lot of jet fuel is being diverted towards diesel pools, and we expect this number to kind of stay here. There's limited opportunity to further reduce jet fuel production coming out of the US refining kit. Now, there have been a couple of bright spots, if you will, even if those bright spots are fairly small, but one of them is export markets. If you look at 2019 and 2020 export markets for gasoline and diesel for the US, you'll see that diesel in the first quarter enjoyed a very robust export situation, and a significant volume of diesel was exported relative to 2019. We saw a little bit of that in January this year, with gasoline exports being a little bit higher. But a lot of US gasoline tends to end up in Latin America, and as the lockdowns extended into 2019, we saw that number come down. Again, jet fuel, we saw higher export levels, and as some of the lockdowns started coming into the US, we saw significant volume of jet fuel being exported to various countries, in particular Latin America. There are implications on this across the value chain within the downstream market. So if you think of the value chain after the refinery, so these are refined product pipelines, refined product terminals, traders, and wholesale and retail markets, all of them are struggling with pretty significant impacts on their business in this particular environment. So if you think of, say, pipelines and terminals, refined product pipelines and terminals, we are seeing refined product pipelines cut utilization rates and capacity as demand declines. For example, Colonial Pipeline is talking about a 20% cut in capacity due to lack of buyers on the East Coast. If you look at terminals and storage tanks, we are seeing all of them getting filled up. The negative WTI futures contract pricing that we saw this past week was driven to a large extent by the lack of storage capacity, and we don't quite see that yet in refined product markets because production of some of these fuels has declined pretty quickly. But in general, storage is at a premium right now. Historically, storage has been a commodity where there wasn't a whole lot to write about, but suddenly storage capacity has become a pretty significant issue. If you look at the trading community, they are struggling with their own challenges. One of them is that all of them are carrying pretty large inventory of higher reed vapor pressure gasoline fuels. This higher reed vapor pressure gasoline fuel cannot be sold in the summer season where reed vapor pressures have to be lower. But there are some waivers that are coming through that will help the traders with this situation. But even then, there will be some elements of the retail markets, even with the waiver, that will be difficult to sell higher reed vapor pressure gasoline into because of local and state level regulations. So I think we expect quite a significant chunk of fuel nominations that have already been made to be stranded and sold at distressed prices, further impacting the trader as well as the intermediate part of this value chain getting distressed. Finally, wholesale and retail markets. This segment is going to struggle the most with reduced fuel demand. A lot of this segment uses fuel as a pull-through product. In other words, if you take an average retail outlet, most of the revenue is coming from selling other products, not necessarily fuel, but fuel acts as the product that drives pull-through. And given the fact that we are not driving as much, people are not necessarily venturing out and filling their gas stations and are not stopping by these gas stations, and that's going to have a pretty significant revenue impact on that final mile that is associated with the value chain. So with that, let's talk through a few of these questions and topics that we have identified at our end. In the meantime, if you have questions or comments, we welcome them. Please put them in the chat box, and we'll be happy to address them as we go through our discussion. So in the meantime, let's get started here. So I have a couple colleagues with me here. We'll start with you, Utkarsh. Utkarsh, you've spent some time in refining operations. You've been a process engineer at one of the world's largest refineries for a couple of years. One of the questions that we have is that we are getting to our clients in general, right, from some of our work is, how low can refinery utilization go? We are at about 60, 70% right now, which means that some refiners are probably much lower than that. But at what point would refiners have to just shut down the entire refinery without cutting utilization further?
Good morning, everyone. So Uday, talking about the utilization rate. So in general, operational rates of a typical refinery is governed by three factors. So one is we can say hydraulic limitations or engineering limitations. Second is the demand or storage capacity that is available for the refiner to store their processed crude. And third is the gross refinery margins. That is also important parameter. So typically when we talk about a cracker or a distillation unit or an FCC, and other equipments in a modern refinery, they are not designed to operate below 60 to 65%. Though some large refiners which have a grassroots refineries, such as those in Gulf Coast and some parts in Asia, they can operate close to 50%. However, operators with multiple trains are in more advantageous position, as they have the flexibility to shut down one train and then they can reduce the crude output by 50%. And this in general won't have any impact on the overall hydraulic limitation of a refinery. So to add on, yesterday I was talking to one of the largest refineries in the in Asia, and still they are operating at 100% efficiency because they have a decent gross refinery margins. And so it's a mixed trend, but yeah, normally it can't go below 50 to 55%.
Yeah, in some ways, right, what we are seeing right now is a good stress test to understand which refineries are the most competitively positioned and which are likely to survive as demand for the declines. Either, I mean, not just because of COVID, but more generally, right? I mean, if we think that, okay, gasoline demand has peaked, then over time, right, some of these refineries are going to get stressed, and their relative positioning on the supply curve is going to determine their competitiveness. So it's interesting to see how this current environment is providing us with some sort of a preview of what is happening in these refining markets. Swati, it's not just utilization, right? I mean, you've been researching this market pretty heavily. What are some other ways in which refiners' operations are getting impacted in the current environment?
Well, Uday, yeah, just as you mentioned, right, it's not just the run cuts that refiners are experiencing right now with the slump in the demand. That is one thing, but one of the other trends that we are seeing here right now is that refiners, old refineries especially, that doesn't have a lot of automated operations, they don't have those kind of infrastructure right now, are particularly struggling because of the social distancing practice that we're seeing right now. And also, as we are seeing, the number of small refineries are getting impacted in the current situation. What's also interesting to see is that even the larger players are finding it difficult to cope with the current situation, especially the refiners that are in larger debt, in particular, are more disadvantaged. For instance, we have Marathon. Marathon is actually struggling a lot with this post-acquisition because of the higher debt and the lower refinery margin that they're struggling with right now.
So this is acquisition, or they required a lot of debt, and that is significant challenges for them. So Utkarsh, right, I mean, so thinking a little bit about recovery, what does that look like, right? I mean, we saw that Chinese utilization rates kind of picked up fairly quickly. I mean, 3 weeks for the entire refining kit to kind of improve utilization by 20–25%. I was a little surprised by that number, because it takes a lot to bring a refinery back online or increase its utilization, right? So can you give us a little bit of insight into that?
Yeah. So there, yeah, you're right. Like, so there are two things. Like, if the refiner is decreasing the utilization rate, like let's say from 100 to 60–65%, so getting back to ramping up the utilization is fairly easier as compared to starting the refinery when it's shut down. So the process, like, let's say when the refinery is in a shutdown process and you have to start the refinery back again, the process of turning that crude oil into clean fuels requires different fuels to work together, and it should all be in series. And the major factor, so there are a lot of steps that needs to be followed to get the product on spec. You have to make sure that you're getting your utilities up and running. Your high pressure steam, medium pressure steam are there for your boilers. You have nitrogen for purging, hydrogen for hydrotreaters. You have to make sure that there is a demand, which is also an important criteria. You have to make sure that all your critical equipments like pumps and compressors are well tested and running. Then the important factor is that you have to make sure that you have enough manpower. You have operational team, maintenance team, workers, because there will be a lot of problems that happens, and there are a lot of issues that are being faced by operators during the startup mode. So in general, we can say that it takes normally 48 to 72 hours to get the refinery on spec when the refinery started from the startup mode. But it depends on the size of the refinery and the complexity as well.
So that's helpful, right? I mean, gives a little bit more granular view of what does it take. And when you think of like, okay, the entire Gulf Coast suddenly say ramping up on utilization, right? I mean, you're talking about dozens of refineries needing help with from catalyst vendors, from industrial gas suppliers who need to be on site. And clearly, at some point, right, the overall system's kind of going to get stressed a little bit because unlike say Asian or Middle Eastern markets, US markets, right, the contractor pool may not necessarily be as deep when it comes to manpower and resources, right? I mean, so I think that is some consideration to think about. So continuing on this recovery theme, Swati, we've been doing a bunch of scenarios and some of this stuff for our research and some of this reports that we are developing. What does fuel demand recovery in particular look like going forward?
Yeah, so we are actually currently working on around this topic, as you just mentioned, and we have in fact created 3 scenarios for fuel demand recovery and dive deeper. Our report is actually ready and available for purchase on the website. So on a higher level, based on our research so far, what we see is a very small chance for a rapid rebound in fuel demand in the next quarter. But we think that if we are looking at a full recovery of fuel demand, it's going to be roughly 2 to 3 years from now.
So it's not a very realistic picture,
right.
But again, we see some variations depending on what fuels we are looking at and
Yes.
things like that.
Right.
The last question that we have here is on recovery and what that will look like in fuel and refining markets and where we will see some of that recovery happen. And I think this is a very interesting question that we have been thinking about right now is I think as we come out of this recovery, are there particular regions in the world that are going to be better positioned, more advantaged? And if you are looking at the market, where should you see where should you be tracking some of that activity? So clearly we think that Asia probably has a little bit of an advantage here. They have struggled with some of the COVID related issues, but they have also been able to enforce lockdowns. India is a good example. They've been in lockdown for the last 4 weeks. It's probably going to be in lockdown mode for another couple. So we are hoping that, they might be able to bend the curve a little bit more from a COVID infections point of view and potentially see a little bit of a recovery there. North America and Europe are probably going to be at the far end of that, recovery curve, if you will. Although I think it'll be interesting to see what exactly, how some of this actually pans out. But one of the other things that we see is that natural gas-based markets are going to be relatively more insulated in comparison to, say, crude oil and fuel demand markets in this environment, especially from a recovery point of view. So those are some of the things that we had in mind. There are a couple of other questions that have come through. One of them talks about what is the impact of lower shale oil production on the downstream sector. So I think in general, the U.S. refining kit has done a great job of repositioning and reorienting its processing configurations to process a lot of light tight oil. We anticipate that some refiners might struggle, or some of the price advantages and discounts that they may have seen for light tight oil, especially in the mid-continent area, might go away as basins like Scoop and Stack get disadvantaged. So I think there's be a little bit of a price impact. I think refiners will have to pay a little bit more. But at the same time, if you take a look at the refining kit on the US Gulf Coast, it is oriented to process more heavy oils. I think that that part of the refining industry won't see a big impact from a lower production of light tight oil from the shale plays. There is a question that came in on impact on Singaporean and Dutch refineries. So maybe we can address that. a little more broadly, right? Like what is happening to the refining kit in Asia, especially Singapore. Singapore has a very complex refining kit, very complex refineries, very well integrated. If you look at some of the largest refineries in Jurong Island, they are highly complex, very well integrated further down into fuels, lubes, and other specialty products. So, and in general, right, I mean, if you, Singapore is one of the countries that's a shining beacon in terms of how they have managed the COVID crisis. So I think we expect relatively small impact and a lot of supply being available and exported into fuel markets. Of course, they will continue to be impacted by the broader decline in fuel demand. A lot of Singaporean refineries export to overseas markets. And because these overseas markets, we are seeing a significant decline that's going to get impacted. Dutch and more broadly European refineries, I think it's going to be a little bit of a mixed bag. I think the smaller, relatively uncomplicated refineries are going to be hit pretty badly. Some of the refineries in the ARA region, for example, have access to a number of export markets, and they are probably going to be better positioned. So I think it's a little bit of a mixed bag there. There are a few other questions that are not necessarily tied to downstream markets. But we can talk about them quickly. There's a question on crude outlook, in particular WTI. I mean, I think we anticipate through the next quarter or so, WTI to essentially trade at marginal supply cost, which is $10 to $15 a barrel. We published last week our updated global crude oil supply demand balance. There's a small snapshot of that on LinkedIn. If you go and look us up on LinkedIn, you will see that the world is oversupplied by 3 to 3.5 million barrels of oil right now. That is assuming that US production comes down by 2 million barrels per day. We don't see US production coming down by 2 million barrels per day right now. So until some of that happens, we expect WTI to trade at the marginal cost of supply, which is $10 to $15 a barrel. There's a question on natural gas, and they're particularly asking about bases. I would suggest I'd like to make a plug here for our webinar next week, where we're going to talk about natural gas and LNG in a little bit more detail. But just at a high level, we expect natural gas prices to kind of hold where they are right now. In general, if there's one element of the oil and gas business that is relatively less impacted right now, it is gas. And that extends across the gas value chain, gas processing, gas pipelines, midstream, end-use gas markets. Some of the industrial gas markets are getting impacted. A couple of steel mills have closed, and that'll probably have an impact on gas prices, but pretty marginally. In the long term, we think what is happening right now from a reduction in oil production, that's a good thing for natural gas, because a lot of gas production is associated gas, and as oil production declines, associated gas production declines, and that'll have a positive impact on gas pricing. So if from an investor point of view, we think that the gas end of the market is actually a little more insulated to what we are seeing right now. So let's see how we are doing on time, if we can take on a few more questions at this point, or if we should wrap up here. Yeah, so it's 11:40. We are already past our timeline here. So maybe with that, let me just wrap up our discussion. Again, we have several webinars coming up. We're going to do this every Thursday at 11 a.m. for several more weeks. We have a couple of the webinar topics listed here. Next week is natural gas and LNG. We have petchem and plastics the following week, and power and utilities on May 14th. We've identified close to a dozen more webinar topics. So we're going to keep doing this every Thursday. So please sign up. The sign up instructions for the next tranche of webinars will be on our COVID page, which is listed there. And then finally, suggest you take a look at our report and our ongoing research focused on COVID-19. If you're interested, please reach out and we'd be happy to share a little bit more. With that, thank you for joining us today. I appreciate the interest. Look forward to seeing you here again next Thursday at 11 a.m. Central. Thank you and have a good rest of the week.
Thank you.
Thank you, everyone.